Welcome to Echo 315, Study Session 4, Introduction to Finance Assets. Introduction. In the previous study session, we examined the source of financing business. In this study session, we'll discuss the nature, types, and characteristics of different forms of financial assets. Learning outcomes. When you have studied this session, you should be able to 1. Discuss sources of financial assets. 2. Highlight the importance of financial assets. 3. Explain the various forms of financial assets. Sources of financial assets. A financial asset is a claim on some other economic unit. It does not provide its owners with the physical services that a real asset does. They are held as a store of value and for the return that they are expected to provide. The financial intermediary, such as mortgage bank or a building society, uses the money deposited by many of its investors, most of whom might not be willing to invest directly in the house. In the economy as a whole, funds are provided by saving surplus units to saving deficit units, which may be individual households, non-profit organizations, company, or the government. This exchange of funds is evident by pieces of paper representing financial assets to the holders and financial liabilities to the issuers. Financial assets exist in an economy because the savings of various economic units during a period of time differ from their investment in real assets. Forms of financial assets. Financial assets often take the form of IOUs issued by government, companies, and individuals. They involve fixed period payments, that is interest, and the eventual repayment of the amount borrowed, that is principal. The two main forms of financial assets are debt instruments and equity instruments. Debt instruments can either provide interest periodically or the securities are sold to the investor on a discount price basis. This involves selling the instrument at a price below the eventual redemption price. The redemption amount is referred to as the face value or par value or maturity value. The interest payment in Naira, stated as a percentage of the face value, is referred to as the nominal or coupon rate. The repayment of principal is either on demand or at some future date, paid in one lump sum or spread over time. In all cases, however, debt instruments represent money rather than ownership to the investor. Specific examples of financial instruments include the following: institutional deposit and contract, government debt securities, corporate debt securities, equities, preferred stocks, and options and futures. Institutional deposit and contract. Cash, demand and savings account, and reserves built up in insurance policies and pension funds all represent fixed money commitment. Some bear interest and some do not. Maturities may run from demand to several years duration. In all cases, these investments originate with some institutions or other companies and can only be transferred to or redeemed by the issuer. They may be difficult to transfer to third parties. Money and current and savings accounts are like debt. Currency is in reality a government IOU. Checks and savings account, referred to as demand and time deposit, respectively, are loans to banks and other financial institutions. Demand deposit bears no interest and are redeemable upon demand. Interest is paid on savings account and Some forms of savings accounts, such as certificate of deposit, have specified maturities. CDs pay higher interest than do normal savings accounts, and penalties are exacted if withdrawal is made before the maturity date. Certain types of life insurance policies build up what is called cash surrender value. A policy holder's share of the reserve is similar to a savings account. A policy can be turned in for its cash surrender value, or money may be borrowed from the insurance company against it. Employees' contributions pension fund organized in anticipation of retirement is another form of contractual savings and hence a financial asset. Employees who contribute to pension fund can usually withdraw their contributions if they leave the company before retirement. Upon retirement, however, the employees receive a pension supported partly by his own and his employer's contributions. Leaving the company before retirement does not usually entitle the employees to the shares contributed by his employers. Government debt securities. The federal, state, or even local governments issue debt securities of varying yields and maturity. Government securities could be regarded as among the safest and most liquid securities available in the market. Government securities can be short-term or long-term. Short-term federal government securities include Treasury bills, which are sold periodically at a discount with maturity of 91 days up to 1 year. In developed financial markets, state and local government agencies issue short-term securities in anticipation of tax revenue. Treasury bond or certificates, though recently discontinued, are also issued by federal government with maturity varying between 1 to 3 years. A long-term financial instrument issued by the government is the developed loan stocks or bond with maturities of 5 to 25 years. Government long-term securities can be of two types, namely general obligation and revenue obligations. The general bond is backed by the paying power of the issuer, whereas revenue bonds pay interest and principal from a special revenue sources. The collections of tolls on a road or bridge which had been financed through borrowing is a loose example of revenue bond. The toll road bond will pay interest and principal from toll receipts. This makes the revenue bond a high-risk instrument if the revenue source falls short of expectations. Corporate debt securities. Corporate bonds or debentures are issued by a variety of companies to finance their activities. These issues vary in quality and yield. They also differ in maturity. Hence, we can distinguish between short-term, medium-term, and long-term corporate debt instruments. Short-term corporate debt instruments. A privately issued debt security is known as a commercial paper. This is an unsecured promissory note of from 30 to 270 days maturity. These securities are used to supplement bank credit and to finance working capital requirements. Two examples are bankers' acceptances and negotiable certificate of deposit. Bankers' acceptances are issued in international trade and carry guarantee, which confers high quality status. Their maturities vary from 90 days to 1 year. Negotiable certificate of deposit is a large corporate time deposit of certain minimum amount for a specified time period. They can be sold and redeemed by third parties. Long-term corporate debt instruments. Corporate bonds or debentures come in a variety of forms. However, the differences between the subclasses lie in the treatment of interest payment and the redemption of principal at maturity. Generally, bonds pay interest every 6 months. As a debt, the payment, current, and accumulated interest are fixed contractual obligations which must be paid before any dividend are distributed to shareholders. Failure to honor this obligation constitutes an act of default, and the creditor may seek legal redress. Income bonds. Income bonds require interest to be paid only if earnings of the company could accommodate the payment. This is an exception to the rule that interest must be paid as at when due on the debt contract. However, this type of debt instrument with residual interest payment is not frequently sold except in corporate reorganizations when new capital is required. Generally, corporate bonds or debentures are associated with debt instruments having fixed return from interest. This makes them attractive to investors with preference for safety and regular income. However, the convertible bonds gives the holder the option to buy a fixed interest security which he can later exchange for a predetermined number of shares at any time prior to maturity. As the cost of this option, convertible bonds usually provide lower interest than straight bonds do, because at some future time, if converted into shares, the bonds might provide more current income, and or there may be a handsome capital gain as the bond price moves up with the value of the underlying shares. Obviously, the underlying shares can prove a disappointment in dividend and in price movement. Call feature. Call feature in bonds enables the issuer to accelerate the maturity contrary to the promise to redeem the bond at maturity. If interest rates decline after the sale of a bond issue, the borrower may want to exercise the option to replace them with instruments offering a lower interest cost. There is always a penalty in form of 1 year's interest that the issuer will be required to pay for the call privilege. Sinking fund. It is a special form of call feature found in bonds issued for the benefit of investors. This provision enables bonds to be redeemed piecemeal over the nominal maturity, similar to the amortization of a home mortgage through regular monthly payment. It provides the investor with the assurance that the principal will be repaid, which may not exist in the case of bonds promising a single lump sum payment at a price not greater than par. Special bond. It represents an alternative strategy to issuing bonds with sinking fund provisions. Serial issues are really several small bond issues carrying many maturity dates rather than a single one. Each series is redeemed as it comes due, usually at par, rather than a single bond issue with a 30 years maturity. We might have 30 sub-issues due 1 year apart from 1 to 30 years. Secured and unsecured bonds. These are issues which are either secured or unsecured. When secured against the risk of default of payment of principal and unpaid interest, there will be lien against specific asset of the issuer. This has the advantage of guaranteeing creditors with specific lien to receive proceeds from the sales of those assets up to a limit of the debt and interest owed. Otherwise, in the absence of any specific asset claim, bondholders become general or unsecured creditors, sharing equally in asset distribution. Bonds are described by different names to indicate the extent of security and the type. Generally, unsecured bonds are called debentures, while bonds secured by real property are referred to as mortgage bonds, with lien holders called first mortgage bond holders, and so on. There are many varieties of bond issues. Indeed, variety is the spice in the bond market. Every investor needs to study the indenture or bond contract, which spells out all the details behind the issue. Equities. Investors in bonds or other debt instruments are creditors to the issuer of the security. Equity issues are securities that confer ownership position on the investor. This entitles the investor to a residual share of profit. Equity investment can be made directly through the capital market or indirectly through other institutions such as unit or investment trust companies. Common stocks and preferred stocks are two main forms of direct equity investment. Common stocks. This confers an ownership position on the holders who have voting power to elect the board of directors, decide on the earning distribution, and have a right to the earnings of the firm after all expenses and obligations have been paid. But they also carry the residual risk, that is, the risk that may receive no income or earnings if the total earnings of the company are insufficient to cover all obligations. There are two sources of return to common stock investors: dividend and capital gains. Dividends are paid only if the company earns sufficient money and the board of directors considers it proper to declare a dividend. Increase in the market prices of the common stock give rise to capital gain. Instead of cash dividends, investors are paid dividend in the form of stock. These are stock dividends. The investor receives more shares, which are typically expressed in percentage terms. A 10% stock dividend means a 10% increase in the number of shares outstanding. The stock dividend is financed by the company through the transfer of some equivalent amount from retained earnings into the share capital account. A company can also declare a stock split. When this happens, the company ends up with more shares outstanding, which sell at a lower price and have a lower par value than the outstanding shares did before the split. Stock splits become necessary when the company's stock price has risen to a level that corporate management considers outside of the popular trading range. Preferred stock. This is a hybrid security because it has features of both common stock and bonds. Preferred stock is preferred with respect to asset and dividend. In the event of liquidation, preferred stockholders have a claim on available assets before the common stockholders. Preferred stockholders also get their fixed dividend before common stockholders get their fixed dividend. Preferred dividend are stated in either percentage of par or naira terms. Thus, the issue might be known as 10 naira preferred or a 10% preferred. The dividends are fixed for preferred stocks, but they must be declared before they are paid. The fixed characteristic makes it similar to bond interest, while the declaration feature is similar to that of common stock dividend. Preferred stock can be cumulative with respect to dividend. This means that if a dividend is passed, all preferred dividend in arrears must be paid before any dividend can be paid to common stockholders. At times, preferred stock can be participatory. This means that it can sometimes receive a double dividend. The stated dividend plus an extra dividend bonus after the common stockholder has received dividend. As in the case of common stock, preferred stock has no maturity date. Options are options to buy, while put options are options to sell. Financial future represent a legal commitment between a buyer and a seller where they agree to exchange something at a specified price at the end of a designated period of time. The buyer agrees to take delivery and the seller agrees to make delivery. Futures on basket of stocks are referred to as stock index future, while futures on fixed income securities are called interest rate futures. Summary. In this study session, you learned that financial assets often take the form of IOUs issued by government, companies, and individuals. Cash, demand deposit, savings account, reserves built up in insurance policies, and pension funds are examples of fixed money commitment. Money, current account, and savings account are like debt. Other forms of contractual savings include certain types of life insurance policies and employees' contributory pension funds. Government issues debt securities of varying quality, yield, and maturity. Short-term federal government securities include treasury bills, treasury bond, or certificates are medium-term, while development loan stocks are long-term. This is the end of study session 4. Thanks for listening.